This is Rod Kusin, Spooman for Risk on Monday, October the 11th, 2010. All times on the chart are Central Standard Times. We're going to briefly review some of the trades that have been taken off of our new strategy and indicator. We're in a short trade at the moment with a target of 1162.25, and we expect that to be hit, but the market's been moving extremely slow all through the day, and we'll talk a little bit about some of the features of our new indicator and strategy in this video. Now, we've made several videos in advance of this, so if you'd like further information about that, you can go back to last Friday, the 8th, and other videos that we cut in advance of the release of this new indicator that were done earlier in September. But let's just look at a couple of things that were taking place this morning. We took an initial short trade off of the top of this move and exited the trade on the indicators that suggested at the bottom of this move we were moving back up. So we just exited that trade. Now let me talk about the several features that are in this indicator as well as the strategy. The indicator, first of all, does several important things. Number one, it will give you well-defined entries and exits based upon the coloring of the bar and the various settings that you choose to set up in your indicator. The indicator will also plot, for lack of a better word, retracement lines as to where we expect the market will return. Those lines are colored white or magenta. There are also indications of once you're in an automated trade, if we believe that we're just hitting our profit target now, we just move there, we just hit it, and we exited the trade. We had a limit order down there at that 1162 level, so that just got hit and filled. But in any case, we have a method of warning the trader if we believe the market is going against him. And then we also have an automated system for telling you what we believe to be the overall trading bias, the direction of the trend, whether it be short or long. Hopefully we'll get one of these alerts while we're doing this video so we can show you what that amounts to. But let's just first describe the retracement lines, because that's the easiest thing to discuss. The white lines, which will appear as the market is dropping, indicates where we believe the market will return to with a high probability. The magenta colored lines are where we believe, and there's one of the alerts that just popped up. Notice it says short bias. And I'll come back to that in just a minute. The magenta colored lines will take place as the market is going up, and these are lines where we believe the market will return to. So as an example, as the market moved down and we had these white retracement lines above the market with a green indicator here that the market is going back up, a person could trade manually long, at least back to these retracements. Now, sometimes they don't make a lot of money, but they're high probability. Similarly, as the market moved up and we had the yellow bars here and here, these would be potentially good places to take a short trade, at least down to the line where we expect the market to go. So you can see as it moved up here, we had two retracement points existing at that time, both of which got hit. Now as we move forward a little bit more, we had a little low retracement here and here as well as here. So as we moved up to this point, we decided to short that manually, and I'll talk about why we did that in a minute, and then just put a profit target down here where we expected the market to go. Fairly simple. Now let's talk about these green dots here. These green dots, once the strategy has pulled an automated trade, not a manual trade, but an automated trade, then the strategy begins to look at the characteristics of the market. And if we see evidence that the market is going to, or at least potentially going to, drop back to or below your entry point, we're going to place a green dot at the bottom of the bar of the ES. And as you see, we had an automated trade take place here. Now, personally, I wouldn't pull a trade there, even if my system told me to, because I have this target below where the automated trade took place. So I would ignore that signal. But down here, once we hit that line, we had another automated signal, and that would have been a good time to get in. But even having done so, these green dots all indicated the potential that the market might come back down and take us out. So that warning signal could be used for the purpose of tightening a stop or dumping the trade. That's what they look like. Now, let's talk about some other entries that we pulled here. Now, these would have been two good places to take a trade. Now, we, for various reasons, weren't trading at that time. We were just letting the system run. But that's where automated signals could have taken place had the strategy been turned on. So let me show you what we mean by that. Here we have an indicator, and I can't fit everything into this window, but these are some of the settings that go into this indicator. The strategy is exactly the same. These are the exact same fields, input fields, that exists in the indicators, with the exception that the strategy actually pulls the trade. And you can set the strategy up to either trade long or short or both. Limit the number of contracts you're trading. Set the number of set a profit target based on the number of ticks, and then set your stops according to your own personal discretion. The advantage of the strategy is that if you have a variety of different, slightly different settings that you want to monitor when you're taking a trade, you can do that with the strategy by just basically inserting a second strategy into the workspace. And the advantage of doing that is that multiple strategies and configurations could then pull trades that meet your specifications. So if you're following what I'm saying, each strategy has its own specifications that are set up by you, the trader. Now, we have certain settings that we feel all of our traders ought to use, but that will not cover every conceivable situation. And so when these trades took place here, they took place because we were pulling a manual trade due to the fact that the strategy specifications were not exactly being met at the time. So we used some discretion and said, we can see that the strategy settings are not going to be met, but that the trade condition exists, so we can pull the trade manually. So you can certainly do it both ways. Now there's one of our, nope, we just lost the alert. Now we're still in this trade. We've still got a couple of contracts working. We're going to set up a stop at 61. We have every reason to believe that's going to get hit. And then we'll exit the rest of our position when we hit that. Now in all probability, what's going to happen here, given the time frame, is that we're going to hit a new low for the day. But we don't know how long that may take. It could happen very quickly, but we just put in a limit order there to take us out of the remaining two positions that we have. And another good reason to do that, not to get too greedy, is you notice this retracement line up here at 63.50. We could turn right around and start heading back up. And since we don't want to take that risk, we would rather just exit the trade and call it a day. Okay, once again, here's our signal alert, I should call it. What the alert does, it provides you with a pop-up window that reaffirms what the bias is, whether we're long or short, and it also sends out an audible, so if you're using speakers, you can hear it. And this will happen periodically through the day when certain conditions are met. It doesn't mean that once you see the alert you should immediately take a trade. It's only telling you what the bias is. So that bias could be short while the market is running up, waiting for an opportunity to enter a short trade based upon specific strategy conditions. And we're getting very close to getting our profit target hit. Now, while we're waiting for that to take place, just a couple of other things. The strategy makes use of certain standard indicators that many of you are familiar with, such as stochastics. Stochastics are involved in the strategy, but they are being run in the background. There we have our profit target hit. So we're out of that position. We're running stochastics on very specific data feeds that are not necessarily related to the ES. We're also incorporating certain volume indexes that are running in the background that are all watching the market to see whether the conditions that we've coded into our strategy are met, and then if they are, the trade is pulled. So there's a lot of things that are going on in the background which we're not showing you on the chart, but they're all coded into the strategy. So quickly to review, we have several important features. We have retracement lines, very accurate retracement lines as to where we expect the market to go before we get there. Entries that are very specific, warning signals, as well as information that will tell us what the bias is on the market at the time. So come and visit us at RSKsys.com, ask for a demo, ask questions. We'll be happy to help you out. This is Rod Kusin and Spooman for Risk.